discussing capital structure and looking at the effects different capital structures have on the earnings per share and share value. This will help in choosing the most effective structure. Various structures include a risk factor, which comes with debt. Capital structure consists of a ratio of debt and equity, which makes up the company's finance. It also looks at which combination of the two would allow the company to maximize returns. The structure depends on what balance the firm wants and what the overall goal is. The structure chosen has a significant influence on the earnings per share value, as more equity means more shares, or more debt incurs higher interest payments, but more leverage. The report will aid in comparing some structures to make decisions on what the company's goal is, if it is to maximize the earnings per share or maximize the share value. The end goal could be profit maximization or wealth maximization.
Financial leverage is the magnification of risk and return through the use of fixed costs such as debt and preferred stock. The more fixed cost debt the firm uses, the greater its expected risk and return. When company increases its debt and preferred equities, interest payment increases, which results in a reduced EPS. The more debt the company uses to finance its operations, the higher its financial leverage becomes. A higher degree in financial leverage causes a negative effect on the company's EPS. In principle, it makes sense. The more debt you have, the less earnings you are going to make. However, in order to reap the full benefits of a business venture, you need to take the risk. As an investor, you cannot invest R1 and expect to make R1,000,000. It's a very unlikely case. A more realistic value to attain such results would be 100,000. So as you can see, one needs to issue more debt in order to obtain a higher return. If a company issues more debt for a while, the EPS might drop depending on the current situation. But if it's a good economic year, financial leverage will most likely have a positive effect on the EPS and cause it to rise in value. As we can see in the graph below, the EPS did not drop, it rose in value immediately as debt increased.
The result of the increase in EPS is due primarily to the increase in EBIT. So what we noticed is that as the EPS increased slowly, the increase in IBT also grew. So if EBIT increases in a small amount, therefore it will reflect EPS increasing in a large amount. Also, there's a negative impact to the increasing financial leverage on financial risk. This is noticeable from the figures of increasing debt levels, and also when we look at the debt ratio, as it increases, the standard deviation also increased, especially for the last percentage, which is 65%. This meant that the firms was highly volatile to risk, meaning that they could go into a lot of debt with the current standards of their figures. But as from 0% up until 35% on the debt ratio, the volatility of the firm was quite safe. And yeah, that's basically the impacts that the firm received on increasing financial leverage.
If the goal is to maximize either earnings per share or share value, our group would recommend the EBIT to EPS approach as a preferred capital structure. If you were to maximize earnings per share, some positives are that earnings per share is simple to calculate and investors take a big interest in earnings per share. The negatives for maximizing earnings per share would be that earnings per share fails to reflect shareholder value creation, which means that earnings per share does not take into account the cost of equity. As a result, does not reflect the full cost of running a business. EPS takes no account of risk, and EPS ignores inflation. If you were to maximize share value, some positives are that shareholders will get good return, meaning good profits. Maximizing share value creates good cash flow, which can reduce debt in the long run. The negatives for maximizing share value would be that it can lead to poor or unsustainable business practices, and businesses might lose focus on what customers want and might do things which are not optimal for consumers.